Good morning, good afternoon, and good evening, depending on where you are. Thank you for joining us for this virtual event on the post-COVID global economic outlook. I am Brahima Coulibaly, Senior Fellow and Vice President of the Global Economy and Development Program at Brookings. The global economy is clearly facing a shock that is unprecedented in its breadth and depth. The pandemic and the policy responses to contain it have brought countries and the economies to a standstill, disrupting billions of lives and jeopardizing decades of development progress. The June edition of the World Bank's Global Economic Prospects, which motivates today's conversation, envisions a 5.25% contraction in global GDP in 2020. This is the deepest global recession since World War II and the broadest collapse in per capita incomes since 1870. It is a timely and rigorous report that is informed by an assessment of the fundamental drivers of long-term growth, including the collapse in investment, which will slow capital formation, the erosion in human capital, and the dislocation of trade and supply linkages, among others. But beyond the headline economic growth number, the pandemic is having a disproportionate effect on lower income countries where the dependence on commodity prices, tourism, remittances are largest, and where economies are dominated by the informal sector with limited ability to adjust to COVID-related measures such as confinements. Similarly, the most vulnerable populations in the advanced economies are relatively more exposed. As such, the pandemic is likely to leave a legacy of even wider inequality between and within countries, unless policy responses integrate this dimension. It was refreshing to see the report acknowledge the impact of COVID on inequality. But as disruptive as the pandemic has been to the lives and the economies around the world, there is unfortunately still great uncertainty as to whether we have seen the worst case scenario. Notably, the epicenter of the pandemic appears to have rotated to the global south, where the ability to combat the virus is more limited, and where fiscal policy responses to cushion the economies are constrained by elevated debt levels in several countries and by the inability of countries to borrow in their own currencies. The lack of sufficient global coordination and cooperation to fight the pandemic means that the global system remains only as strong as its weakest links, and the virus will remain a threat to the global economy unless it is eradicated in every country. We are also seeing a resurgence of new cases in some advanced countries, notably the United States, causing policymakers to dial back reopening plans. Meanwhile, and despite encouraging progress, the timing for the discovery of a vaccine or treatment remains uncertain. So the complexity of the current environment raises several questions in my mind. How sensitive is the economic outlook, particularly the rebound projected for next year, to the assumptions about the timing for reliable vaccine or treatment? What will be the long-lasting effects of the pandemic on the fundamental drivers of economic growth, such as human capital investment, but also on critical sectors that were hit particularly hard, such as tourism, global value chains? What do we make of the apparent disconnect between Main Street and Wall Street, where stock market indices have largely recovered much of their losses, despite a highly uncertain economic environment and outlook? Finally, are there any silver linings? Where do we see opportunities to build back better and stronger economies? How should policymakers balance the near-term priorities while seizing the opportunity to revive the sluggish global productivity, which has been threatening major economies with secular stagnation since the global financial crisis? These are among the questions on our minds at Brookings as we imagine what a post-COVID global economy could look like. We are very fortunate to have with us a diverse panel of experts to help make sense of this all. And I look forward to the conversation, which will be moderated by my colleague, David Wessel, following a short presentation by our World Bank colleague and Brookings affiliate, Ayan Coase. Thank you, and over to you, Ayan.
Thank you, Kul, and thank you for organizing this session. It's great to be a part of this distinguished panel. Let me share my screen quickly, and then provide the remarks. So we released our report, Global Economic Prospects, in early June. Because of the time constraints, I'm just going to focus on 3 points. The first point about the short-term implications of the pandemic. As you said, this is going to be deepest and most synchronized global recession since the Second World War. For emerging market developing economies, it will be the first recession these economies are going to experience as a group on record. Against this somber outlook, risks are still tilted to the downside. The second point is about the long-term implications of the pandemic. And there, as we have seen before, following deep recessions, there are going to be lasting scars. In the context of the pandemic, we are expecting weaker potential output, weaker investment, and weaker productivity over the long term. And finally, policy priorities are on the agenda, as you discussed, and they're addressing the immediate health crisis is the urgent priority. But beyond the crisis, policymakers need to look forward and undertake policy measures to lay the foundation for strong and sustained growth. Throughout the presentation, I'm going to use this acronym, EMDs, that refers to emerging market and developing economies. How do we see the growth outlook this year and the next year? By now, it's clear that there is a plunge in activity around the world. We are expecting global growth to be around minus 5.2% this year. In the case of advanced economies, contraction is going to be even larger. For emerging market developing economies, these are the economies that were really the engines of global growth for an extended period of time. As a group, they will experience the first recession and they will see their output to contract by about 2.5%. If we look around the regions, you see differences, but pretty much a serious downturn is underway. In the case of East Asia Pacific, we are expecting positive growth primarily because China will deliver growth this year, and it will be the only major economy delivering positive growth by about meager 1%. That will push the East Asia Pacific growth to around 0.5%. Other than that, all regions will have historical contractions. Take Latin America, Caribbean. It will see a contraction it has never seen over the past 100 years. Growth will be around minus 7.2%. Sub-Saharan Africa, Europe, Central Asia, Middle East, North Africa. Regions, a number of countries with commodity exporters will see significant declines in their growth rates. Even in South Asia, a region that has no commodity exporter will see a historical contraction, as India will contract by about 3.2%. Next year, growth will come back, but we are expecting a relatively modest recovery given the downturn we have this year. This is a truly historical global recession. If we go back all the way to 1870, which we have reasonably good data, there have been 14 global recessions. In each global recession, you saw global economy contracting in per capita income terms. This will be the fourth deepest global recession, deepest one since the Second World War. The other three global recessions are important to understand here. Two of them were associated with world wars. So if you take out those two, this global recession will be the deepest since 1870, after the Great Depression. Another notable feature of this episode is that global economy will see the highest share of economies experiencing contraction in per capita output, slightly more than 90% this year. This number is higher even than what we saw at the height of Great Depression. There are risks down the road, and these risks still tilted to the downside. The single most important risk is a second wave of pandemic coming. Now, if you look at where we are, pandemic is pretty much under control in advanced economies, except the United States. If you take out United States from the sample, you will see that actually the number of daily infections went down significantly relative to where we were at the beginning of March. On the other hand, in emerging market developing economies, the pandemic is in full force. In Latin America, Caribbean, in Sub-Saharan Africa, in South Asia, we see a significant increase in the number of infections. These are the regions with limited health service capacity and limited testing capacity. So we have a limited understanding of the gravity of the pandemic in these regions. Now, beyond the short term, this pandemic will have long-term implications. There is no question there are large losses in output levels. And these losses are not going to be recouped next year when the growth comes back. In fact, as it happened during the 2009 global recession, we are not going to go back to pre-pandemic levels of output anytime soon. These types of deep recessions will have long-lasting scars, as they did in the past, and negatively affect physical capital accumulation, human capital accumulation, and of course, productivity. Now, another important consequence of this pandemic is how the global economy's ability to basically generate growth is going to be constrained by the devastating shock we are going through. Prior to the pandemic, global growth forecasts, long-term, 10 years ahead global growth forecasts, have been downgraded since the global financial crisis. In 2010, forecasters thought that the global economy 10 years ahead would generate growth about 3.3%. That number declined below 3% in 2014, and now it is around 2.4%. In all likelihood, the pandemic will have a long shadow over global growth expectations. Now, fiscal and monetary policy authorities provided an overwhelming response to the crisis. This response was necessary, but of course, sooner or later, there will be a bill. That bill will be in the form of much higher debt levels and much higher deficits. And it's going to be important, governments, to basically try to withdraw the stimulus when the time comes and think policy frameworks to basically reach sustainable levels of debt. This is another important risk we need to pay attention to. Every crisis has its twists and turns, and this crisis so far has not translated into the type of systemic financial stress we saw in previous episodes of deep recessions. But we shouldn't deceive ourselves. As we saw after the global financial crisis, there might be repercussions associated with the balance sheets, especially of those economies highly indebted. Policy priorities are clear. In the short run, dealing with the health and economic crisis is key. This will require supporting healthcare systems, helping vulnerable groups, and aiding viable corporates. The idea is to keep the economy afloat and supporting the activity in an intelligent way. Coordinating policies globally is also critical. And in this context, we need to provide a debt relief to those economies, the poorest emerging market developing economies. They need this debt relief in the desperate times they are facing now. As the crisis abates, policymakers need to look forward and put in place policies for sustained long-term growth. And there are a number of important items. There is always this discussion about what is urgent, what is important. There are urgent policy issues here in the context of the short term, and there are critically important policy priorities when we think about the aftermath of the pandemic. And there, strengthening institutions and governance practice is going to be critical. Improving debt and investment transparency to attract the necessary inflows to support activity will be important. Above all, coordinating policies globally to address global challenges is key, including those related to threats to global public health and providing the necessary information when these types of challenges emerge. Global trade and financial systems are also experiencing headwinds. Multilateral agreements to push forward and agreeable and basically more friendly trading system and the financial system necessary to establish. I think the crisis clearly tells us the types of risk we think very small probability of emerging and manifesting themselves can and do happen. In this context, it's going to be important to address the challenges associated with the climate change. So, like we saw during the global financial crisis, there is a discussion about the shape of the recovery. Many shapes have been proposed: the V shape, W shape, U shape, the saxophone shape, the bathtub shape, the Z shape, the swoosh shape recovery. I think this debate is useful to simplify the kind of the trajectory we are thinking about as global economy struggles with the pandemic. Let's make no mistake about the nature of the recovery. Whatever it is shaped, it's going to be a painful one. And policymakers need to provide immediate, comprehensive, bold responses and think through how they are going to basically eventually turn their economies around. With that, let me stop here. Thank you.
Thank you, Ian. So I'm hoping everybody can see the whole panel at this time. I'm David Wessel, Director of the Hutchins Center at Brookings. I'm very glad to be moderating this panel. In addition to Ian, I'm joined by my colleague Ishwar Prasad, who splits his time between Brookings and Cornell, which is why you have Cornell in the background, in case you were wondering. And Joyce Chang, who's the Chair of Global Research at JP Morgan, which you can tell from her backdrop. She only has one employer. And Brahima Kulalabi, who you met at the beginning of our program, who's the new Vice President for Global Economics and Development at Brookings, is going to join us as well, particularly given his interest in Africa. But I'd like to start with Joyce. And Joyce, I'm interested in whether your view of the world economy matches the one that Ian just laid out, and particularly what you see in emerging markets. You talk in your recent report I saw about a growth rebound, a powerful growth bounce in the second half of this year in emerging markets. But we know, and Ian's presentation made clear, that it's a very diverse set of markets. Latin America is different from Africa, which is different from China. So how do you see the world, and particularly how do you see it differently than the World Bank?
Thank you so much, David, for those questions. And thank you so much to the Brookings Institution for the invitation and for an excellent report from Ayhan. Well, let me just start with the first question, actually, that Ayhan had brought up is, why is there such a disconnect between Main Street and Wall Street? And then I will go into the emerging markets discussion. And the first thing I would say is just that this time around, compared to the global financial crisis, you had an immediate proactive response from all of the central banks, developed country and emerging market central banks. And if you look at the size of the expansion of the balance sheet, we estimate that it is about 20% of GDP. Now, if you compare that to what happened during the global financial crisis, that it was about 6% of GDP. So you've expanded the central bank balance sheet by more than 3 times what we saw in the global financial crisis. At the same time, if you look at how low interest rates are right now, we estimate that nearly 70% of global government debt has a yield of 50 basis points or less. So you've got negative yielding debt, but then you have basically close to zero yielding debt for 70% of the market. And that's pushed money into the equity market. At the same time, your market liquidity, though, is really poor here. So you've got to be careful that you're going to have this return in volatility. I mean, we estimate that the liquidity is still about 60% weaker than it was below in the market depth what it was pre-pandemic. So that's the first thing I'd say about the disconnect between Main Street and Wall Street. You've seen a Fed balance sheet that has expanded by $3 trillion. You see that they're on a buying spree of epic proportions here. But let me just turn to the growth outlook and the growth forecast. And we do agree very much with Ayhan that this is the largest decline in 70 years. It's the 3rd largest in 120 years. And we have the advanced economies contracting by 4%. And in emerging markets, if you take out China, because we have China growing, one of the few countries growing positively at 2%, you've got a contraction that's in the order of 6% or more in the emerging markets countries. And so I would say that, yes, we do see a rebound, because the first half of the year, we had about a 16% annualized drop in GDP. So when you turn everything off, you're going to get a rebound, but this is the easy part of the recovery. And I would say it's an incomplete recovery with respect to the level of GDP. At the level of GDP, at the end of the year, we still will think will be about 4 percentage points below where it was pre-pandemic. So you've got V-shaped numbers that are going to be printing. We see 20% up for GDP in the second half of the year. But if you look at where we are with respect to GDP, the level of GDP, still 4% below where we were pre-pandemic. And it's the income loss, the product loss, the productivity losses that I think are going to be very large, long-lasting damage. So you've got another 1 or 2 months where I think the data prints coming out are actually going to look, quite good. But this is going to be trickier in the 4th quarter of the year, because many of these income supports will begin to roll off. And what are we left with? We're left with a fiscal deficit that we're estimating at 13.8% of GDP, the highest in 80 years. We're looking at public sector debt burdens that are 15 to 20 percentage points higher. And we would break that down: a third due to lower growth, a third due to contingent liabilities, and we're looking at, in the emerging markets, really 3 different scenarios for emerging markets. China has been doing better. It's near full recovery right now. And that's been a surprise. Korea, Taiwan are doing better. So the North Asian countries are faring better out of this. They have the smallest output gaps. But if you take a look at Latin America, we're looking at 9% contraction for Latin America. And this is where the pandemic still has not peaked yet. And this is where we're seeing, really some of the biggest losses that will take place. And then you have the sub-Saharan African countries, some of the very highly distressed countries where there is a true need for debt forgiveness, or all of these official relief measures that have been in discussion by official creditors and by the G20. So it's very hard to characterize emerging markets as one block. But China is very important here. China, we estimate every 1% decline in China's growth is about 0.4% off of global growth. So the outlook for China sort of skews the numbers, which is why we look at the numbers ex-China and with China. And China's recovery, including the exports, has been surprising. But we're looking at a decline for trade that has been going down consistently over the last couple of years that's going to continue. And let me just finish with a comment on the key risk ahead. We do look at the US elections, the US-China tensions, Brexit, as key risk ahead, as well as the possibility of a second wave. I think what you're seeing now is actually a very stubborn first wave, that there still is fears of a second wave, and some time before you will have a vaccine ready for widespread use. But the losses at the corporate level are going to be significant despite the market rebound that we've seen in financial markets. We estimate that corporate profits dropped by about 70% in the second quarter of the year. We're at a 6% default rate, the highest in 10 years. We've had $150 billion of debt downgraded from high grade to high yield to junk. But you've still seen this tremendous level of support that's been coming from the G4 central banks more broadly, which has supported the market. And you've seen that it's not just developed country central banks. 15 emerging market central banks are now purchasing assets as well. So whereas in the global financial crisis, it was about the policy easing, we exhausted a lot of that. You've really gone from QE to credit easing to CE. And that's kind of the lasting consequences that we need to monitor going forward.
Joyce, let me just push you a little bit on the market thing. So you said that the stock market has been strong despite the rather scary headlines about the economy, in part because there are few alternatives for money and the central banks have made it attractive. But is the market basically assuming there won't be a second wave or a lasting decline in globalization or or long-lasting decline in productivity? Is the market fully factored in for some of the risks that you elaborated?
Well, I think the market is, first of all, factoring in that the Fed is going nowhere anytime soon, that the central banks are in this for the long haul, and that this has been a real paradigm shift. And I think they're assuming that there will not be a lockdown like we saw in March and April. That even if you have a second wave, it's not going to be met with that type of lockdown, that we are seeing second waves, but we're not seeing as big a wave of fatalities as we saw a few months ago. But I think what the market is looking at is a search for yield. 80% of the S&P 500 stocks now have a higher dividend or shareholder yield than 10-year US Treasury yields. So if you've got 70% of the debt at close to a zero yield or sub-zero, there has been a search for yield in the equity market. You've also had record issuance out of the U.S. high-grade corporate bond market. We think it will hit $1.6 trillion this year because corporates are trying to get ahead of this. They're trying to really create the fortress balance sheet and raise money when they can do it at near zero so that they do have a cushion if this continues to endure. But I would just say that, it's not a V-shaped recovery. It's a partial V. What we're seeing right now is a necessary but insufficient condition for a V-shaped recovery. It's a very incomplete recovery.
Thanks. Ishwar, I'm going to invite you to react to whatever you want, but I have one question. So what Joyce and Ayan have documented is just an extraordinary response by policymakers, fiscal and monetary. And of course, there's one set of people, economists, many of them we know, who say, thank God, and this is the reason why we're not looking at Great Depression 2.0. But I hear a lot from lay people about seems like some kind of perpetual motion machine. How long can we go on with governments issuing trillions of dollars of debt and the Fed printing enough money and buying half the bonds that the Treasury issues? And what are the risks to this sort of policy response and perhaps asset bubble?
The risks are a key issue, David, and certainly listening to where Kuhl started reading Ayhan's report and listening to Joyce, there is a great deal to be concerned about, but perhaps we should also be humble enough to recognize that we economists are terrible at forecasting turning points of recessions, and it's a lot easier to get carried along with wherever the economy is right now. And certainly all the indicators that one looks at right now would suggest that there is a lot worse to come. And yet, the financial markets seem to be doing okay. And Joyce has given us some reasons why that might be so, that is really not related to fundamentals. But there are a couple of promising things that are worth keeping in mind. I mean, who would have thought just 2 months ago or 3 months ago that the Chinese economy would be where it is today, where, as Joyce pointed out, a recovery does seem to be in motion. The manufacturing sector is doing all right. Even the services sector does seem to be picking up. The capital flows to emerging market economies remarkably are picking up once again, even though there is a lot to be concerned about, especially among the weaker emerging market economies. And even in the US, we are beginning to see some of the purchasing manager index numbers beginning to come back up. So perhaps it's not all doom yet, although certainly at this stage, the doom story is a lot harder to tell. And it's easy to tell partly because if we separate out what's going on into the demand and supply components, the initial phase of this shock did look like a massive demand shock, although there were certainly supply disruptions because of the lockdowns as well. But there was a perception that perhaps once we got past the lockdowns, the supply aspect could be better taken care of. And on the demand side, certainly macroeconomic policies, both fiscal and monetary policies, can counteract some of the downturn. And as you pointed out, David, there have been huge amounts of stimulus that practically every major economy has thrown at this problem. And it's at least forestalled the worsening of demand, although whether it's supported demand enough to provide a robust recovery is far from obvious yet. But the bigger question in my mind is whether these policy tools, going back to your question about the risk calculus, are really going to help in terms of supply. IHAN's report clearly points out that there are significant concerns about productivity. And in fact, coming into this recession, we already had very slow productivity growth coming out of the last recession that was spawned by the global financial crisis of 2008, 2009. Private investment across the world was quite weak, even in China, which has had decent investment growth. Much of that has come from investment by the public sector, by the state-owned enterprises, rather than private sector investment. The other concern is that even though the financial system doesn't seem to be under distress, and again, IHAN pointed out that this is a very important distinction from some previous recessions, when the financial systems, especially the banking system, came under enormous stress. That's not quite happened this time, but financing conditions are still very tight, especially for the firms that are very important in terms of employment growth and productivity growth in practically every economy. And these are the small and medium enterprises, and especially in economies like China, enterprises in the service sector as well. So if one looks at the longer term prospects, how long this downturn could be, I think there are some very significant worries on the supply aspect. Again, Joyce and IHAN both referred to the disruptions that may be taking place to global supply chains, to firms, both domestic as well as broader supply processes. And these may be with us for a while. Here again, one could potentially tell a positive story. Many firms, many countries are, of course, experiencing very significant negative effects on these supply chain disruptions. So one obvious answer might be onshoring. Another obvious answer might be diversification of supply chains. Both of these ought to lead to more investment once things settle down. Because when you're trying to rejigger supply chains, that is going to lead to some more investment. Perhaps we'll get less of the benefits of globalization and the cost effectiveness of global supply chains, but you could get a short-term boost in investment. And therein lies one other problem that I'll end my remarks with, which is confidence. Business and consumer confidence are shattered right now. Businesses already were not investing as much as they could, even firms sitting on large amounts of cash, simply because they did not feel that the environment was conducive. Remember, we're coming into the COVID pandemic-induced recession on top of a period of very significant trade tensions between the two largest economies in the world. and trade tensions between the US and many of its other major trading partners. So investment was already weak, business confidence was weak. One thing that happened in the 2008-2009 financial crisis was that the G20 did sort of stand together and say we will do things to try and control the negative effects of this financial crisis. What is remarkable is that this time we have had national governments, central banks stepping up to the plate, as Joyce pointed out, even more dramatically than they did during that crisis. But I think at a time like this, the sense that there is a concerted strategy, both at the domestic level and at the global levels, is really important in bringing back business confidence and consumer confidence. And we haven't quite seen that happen, partly because of lack of US leadership, but also because I think blame mongering about the pandemic seems to have become an important pastime of national leaders rather than getting to grips with the problems that we face at the national and global economies. So I think that is going to be an important thing to fix. And to my mind, one of the critical issues as we look at what the shape of the recovery is going to be and whether, in fact, this downturn gets to be more prolonged is really whether governments, in addition to these measures they're taking with monetary and fiscal stimulus, really provide some sort of concerted strategy for dealing with the public health dimension, but also the broader policy dimensions and coordination of these policies, both domestically and globally. I'm not that hopeful, but I hope things will change.
Let me ask you, Eshwar, how would you grade the performance of the International Monetary Fund and the World Bank? Have they been aggressive enough?
They've certainly tried hard. I think the willingness of the IMF and the World Bank to use their resources to the extent possible to buffer especially the much weaker economies and to try and coordinate debt relief, I think has been very much along the right lines. Certainly there's been some resistance from national governments, but I think for the small economies, some moratoriums on debt payments, but ultimately grants in the form of debt relief or debt write-offs are going to be crucial. None of the standard adjustment mechanisms that came into play in previous crises are working well for the emerging market economies and developing economies right now. You don't have China, even though it may register some mild positive growth this year, pulling the world economy, including commodity exporters, out of this problem. For developing countries that rely on export revenues, even when their currencies are depreciating, there is virtually no external demand. Remittance flows have shrunk enormously. So on practically every dimension, the smaller developing economies and the poorer ones are getting hammered. I think the IMF and World Bank have certainly done the right things, but a lot more needs to be done because after all, the resources of these institutions are limited and all they can do is really provide catalytic efforts for national governments and ultimately for the private markets.
Cool. One of the things that both the World Bank and the JP Morgan report underscore is that this crisis has not been as bad in Africa as it's been in Latin America. Penny Goldberg, who used to be the chief economist at the World Bank, now back at Yale, did a presentation at the Brookings Papers on economic activity where she expressed some surprise that COVID hadn't been more devastating in the very low-income countries with not very robust public health systems. So I wonder whether you think that, A, should we believe the data on Africa, that Africa has been relatively less harmed by this? And B, is this just the calm before the tsunami hits them?
So it is true that the numbers for Africa have been relatively low when you compare it to other regions, but the reality is they're still going up daily, and we're seeing no signs really of it's slowing down. So to the extent that this really reflects the reality on the ground, and then Africa is spared by the worst of it, it's very much welcome and may suggest that some of the policy measures have been taken, have been effective. But I would caution, because detecting cases means that you've also been able to do widespread testing. And the health capacities really such that we can't be confident that there's been sufficient amount of testing to declare that Africa will be spared by the worst of it. But we certainly hope that that will be the case. But for that to happen, we really need to step up in terms of randomized testing to be able to know for sure. On the economic front, I think just to put in context, before this pandemic, really Africa was looking at a very robust quarter century in terms of economic growth. You're going from early 2000 through 2025, it was going to have a 5% growth on average. And that would have been home to 7 of the 10 fastest growing economies through 2025. And so this COVID moment really came and disrupted that drastically. On the economic numbers and the forecast, and including the ones in the World Bank report, relatively speaking, it's still not looking bad, but you have to remember that population growth there is also really high. So we need first to normalize this by population growth and look at it in per capita income terms. So you would see a little bit narrowing of that gap in terms of how COVID is affecting the economies. And it's going to be the continent's worst economic performance in 30 years. So for them, this means quite a lot. And as was alluded to earlier by Ishward, I mean, they've been hit on every dimension. Commodity prices, you have oil price tank by about 55% in the first 3 months. But in the 2014 shock, it took several months for it to reach that level of decline. So that's certainly dealt a severe blow. You have remittances, tourism that make up a big chunk of those economies. They're going to suffer from it. If you look at remittances, for example, it was about $85 billion in 2018. Just compare that to ODA, which was around 50 billion. So it's kind of showed you the extent to which this can really affect the economies. But importantly, these are economies highly reliant on the informal sector. So then confinement there has really meant that a very disruptive economic activities, foregoing living wages, etc. So that's also going to have its own economic effect. So in many ways, it's like having many crises in one for the African economies. But it's really comforting to hear that there are some green shoots, at least in terms of recovery, because in Africa's case, the performance of the global economy and the external sector will be really important. If you remember, Africa is one of the regions where the economic crisis preceded the health crisis, mainly because of the reliance on the external sector. So similarly too, as we're seeing signs of recovery in some external environment, particularly China, we should begin to also see some positive spillovers from it. But the key issue is how to come out of it while still being able to preserve some fundamentals. And there, the ability to mobilize resources to really respond to the health and economic fallout has been a significant constraint. Accordingly, you're only seeing about 1% of GDP in terms of fiscal response. For the advanced economies, particularly the US, we've seen over 10%, and other major economies somewhere around 4 or 5%. But in African countries' case, very meager, less than 1%, because these countries are really unable to borrow in their own currencies to master the kind of fiscal response that is necessary to get ahead of this crisis. So this is where IMF and the World Bank and other international institutions' efforts have been very helpful, but as was pointed out by Ishward, they've gone a long way, but not enough. And what has been missing is the being able to think outside of the box and to adopt more unorthodox policies that, like many other advanced economies have done. But policy responses have so far been a bit incremental and a bit constrained by policy orthodoxy, which is not really what this moment demands.
Interesting. Well, give me an example of some non-orthodox thing that you think the international financial institutions ought to be financing for low-income countries.
For the low-income country, I think for starter, they could begin by looking into the SDRs. And I think many have suggested creating $500 billion of SDRs, or
special drawing rights, the currency.
Even 1 trillion, yes, the special drawing rights. So, but then in that case, as was alluded to, it requires a supermajority on the part of the IMF to be able to pass that. But the political will is just not there. And I think the G20 has tried, but they just could not get that political support for it.
See, Ian, one of the things that has been noteworthy over the last several years is in part thanks to China, but not exclusively, a steady decline in the number of people who fall below the World Bank's definition of poverty. While there's been an increase in inequality within countries, like within the United States, there's actually been a decrease in global inequality, in part because so many people at the bottom have been lifted out of poverty. And it looks like this progress is being disrupted by the COVID pandemic and the global recession that you described so graphically. And I'm curious whether you think, well, first, how big a deal is this? But secondly, is this something that we can recover from, and in a couple of years this will look like a hiccup, or is this a long-lasting setback to that progress?
David, implications of the pandemic for development outcomes have been quite significant. Let me start with this issue of poverty. So I talked about this global recession, and that global recession in the baseline, we are expecting, 5% contraction. A good outcome we are thinking will be 4%. Worse outcome could be 8%. Depending on these outcomes, the number of poor will increase anywhere between 70 to 100 million this year. This will be the first time after a number of years we see an increase in the number of poor globally. And of course, with this deep recession and the health crisis we are seeing around the world, there are these gains. Global economy has been able to register over an extended period of time in the context of, broader development objectives. And I think that we are going to lose a significant share of those gains. So there is short-term damage. Beyond that short-term damage, when you look at the kind of the long-term consequences, one important issue, how this pandemic will affect potential growth, the ability of these economies to generate growth. And there we are really concerned. Ishwar mentioned the confidence issue. Confidence, of course, plunged. We have seen the type of uncertainty, policy uncertainty we have never seen before at the global level. That has a direct impact on investment. And that impact, will be there for the foreseeable future. And then you have this millions of unemployed. Unemployment comes always with erosion of human capital. In many countries around the world, school-age children having all types of challenges to acquire the type of education they used to acquire under normal circumstances. There is erosion of human capital associated with this, constrained schooling environment. And then, of course, when you have this serious slowdown or outright contraction in investment, it has implications for productivity. Why all of these collectively important? You need to have growth to reduce, poverty, and you need to have growth to have, a larger pie and to have income distribution to improve the inequality outcomes. So the pandemic creates all types of challenges, and I'm afraid in terms of development outcomes, the types of challenges we have prior to the pandemic will be basically magnified because of it.
Joyce, you mentioned briefly, used the phrase deglobalization, and I'm wondering whether you think we'll look back at this period and say that 2007 was the peak of the short-term peak of globalization, trade, and foreign direct investment, and whether we'll be on a steady downturn, trade as a fraction of GDP and stuff like that. And Ishwar raised the possibility that this might have some short-term benefits because of increased investment, but the risk is, of course, that it will lead to the lower productivity growth and efficiency that the World Bank report and your report speculates. So I'm just curious how you think about this, recognizing that we won't call you back in 10 years and remind you what you said today.
Well, deglobalization is a very serious long-term threat, but it also is within some of the control of the political actors. So the US elections, the way US-China tensions play out, Brexit, all of these factors are big influences. But what we really saw was that trade intensity have, basically stalled after the global financial crisis. And then you've really seen sort of, four waves of what I would call different shocks. You had the recession after the global financial crisis was the first shock. The second was 2015, 2016, when you had the slowdown in emerging markets, a collapse in oil prices. Then in 2019, you had the US-China trade tensions, and now you have basically the pandemic and all of the supply disruptions. But it is something that also happens very gradually. And I would say that, if you take a look at the US-China tensions, one thing that one has to note is if you look at the American Chamber of Commerce and the European Chamber of Commerce surveys, and you look at the business responses, 83% of US companies say they're not considering relocating their manufacturing outside of China. Only 11% in Europe say that they're considering this. And you still see that there are a lot of things that you can't delink that easily when you look at China. So first of all of these companies still want access to China's market. Secondly, China is still the only country that, if you look at the 666 manufacturing components, can actually manufacture all of them. And they have a skilled labor force with 1.4 million of STEM graduates annually. They have the infrastructure, and they also have government support in some of these sectors. So I don't think that supply chains are going to move that easily. I do think you'll see more companies thinking about China plus one. And you will still continue to see between the US and China, what was a trade war has really been always, in my opinion, more of a tech war, where these issues are going to continue to linger on, irrespective of which administration it is. I mean, there's real Republican and Democratic concern on some of the technology issues. So I would say that, we do see this as a longer term threat, and one that had started well before this pandemic, as far as having different waves of shocks that it's working through. But I wouldn't over exaggerate that you can actually change the model that easily. And I still do think that there's a lot of discussion that will, take place after this crisis on what is the right kind of way to look at getting back to a more multilateral structure, or will it stay in something that is, in more of a populist realm? One thing to note is that many of the populist leaders have lost support during this pandemic. They have not gained support. So there are reasons to have some optimism as we look ahead.
So we have about 8 minutes left, and I thought I might ask a question that each of you can answer briefly. And basically it is, beyond the obvious, the number of cases of COVID, which will be the most important factor, what is one thing or two things that you think will most determine whether we have a more robust recovery in the beginning of 2021? What is the things that really matter? Ishwar, can I start with you? What would you think would be the most important thing?
So I just testified before the House Committee on Small Businesses on Supply Chain Disruptions a few days ago. So I've started getting much more attuned to the fate of small businesses. And I think what happens to small and medium enterprises, as I alluded to in my earlier remarks, is really going to be crucial for every economy. These are the firms that have suffered the most because they've had traditionally the smallest cash and other types of buffers. And if you look at an economy like the US, the net job creation by these firms is not that large. But right now, given that they've taken on the brunt of the job losses, unless that sector comes back up relatively quickly, it's going to be difficult to sustain decent employment growth in a robust way in the US. If you look at China, most other emerging market economies, small and medium enterprises are absolutely crucial to both employment and productivity growth. And having financial systems not be under stress is a good thing, but there is going to have to be a way, partly with policy support, to make sure that these firms are taken care of. Because if not, economic revival is going to be very difficult to come by, especially in terms of consumption. We've seen the uncertainty that Ayhan alluded to, spiking household saving rates. That's, of course, largely because of the better off in most countries raising their precautionary savings, but there are still many people hurting, and those people that are hurting are usually tied to those smaller enterprises. So that, I think, is really the key to economic revival.
Cool. What would be
yeah, I think I would agree with what each one said, but what I would point out in particular is that this crisis, I view it as first and foremost a health crisis, and then secondarily an economic crisis. So to me, the certainty around the rebound begins with having clarity on the timing, either vaccine or treatment. If we do not have that, and then this is more prolonged, I think the situation will be untenable, no matter how much stimulus we pump into the economies.
Okay. Joyce?
No, so let me agree both with all the points that have been made, but I would say a key thing that we're looking at for the U.S. in particular is labor income. So you've got the easy part of the recovery, you turn everything off and then you turn it back on, but the real question is, are you going to be able to create jobs? So the unemployment numbers actually were not as bad as some people thought, but we went into this with a 50-year low on unemployment. Mm-hmm. And if you look at the packages, private labor income, we estimate has contracted by 1/3, but you basically have the stimulus packages have made up like 20 percentage points of this. So those stimuluses will roll off. So will those jobs return? And it's very much in line with what Ishwar said. Will these small and medium-sized businesses be able to be sustained and to rehire? And what happens when all of this stimulus rolls off? But I would totally agree that we have to go back to the science of this. What is the duration of this recession? Because we're assuming right now that it's very deep, but it's also short-lived. So will there be a vaccination that is actually suitable for widespread usage amongst the population? And the third thing I would just mention is commodity prices. Commodity prices are still incredibly important for emerging markets countries, and particularly for Latin America. I think that, given that that's one of the hardest hit regions, that's going to be very important. That's also very tied to the China cycle as well. But we heard about this for Africa as well. That's also been key to the outlook, that you still have that, and that the commodity prices are a big driver for emerging markets.
Thanks. And Ayan, what would be at the top of your list that would increase the chances of a less unpleasant recovery?
A recovery can be strong and sustainable only if it is basically coming along with a sharp increase in confidence. I agree with what other panelists said. We need to see confidence coming back, and we really need to see that financial market participants think that we will not have a financial stress event down the road. These two go hand in hand, and all gonna depend on how policymakers are going to carry on. It goes back to the question you asked at the beginning. Sooner or later, some financial market participants might ask how we are going to basically go forward with this large-scale policy support measures. I think that that type of question can generate all types of confidence issues and can trigger financial stress episodes as well. So we need to pay attention to basically the confidence is the single most important indicator as we are moving forward.
Great. Well, I think we're out of time. I want to thank Ayan for a very comprehensive report, and I recommend that if people only looked at your slides, they go to good taste, but there's a lot more in the details of the report, which is, of course, on the World Bank's website. I want to thank Joyce for bringing us the perspective of JP Morgan, which has put out really extraordinarily useful research and updates during this crisis when we're flooded with stuff. I always read the JP Morgan stuff. And Ishwar, who excels among my colleagues in answering almost any question thoughtfully in complete paragraphs, for which I'm always envious. And Kul, we want to congratulate you on your new post and the important leadership you'll provide to our global economic development. But we hope you won't stop thinking about policies towards Africa, which, as you point out, is the place with a growing population and had so much potential that now seems threatened. So with that, I want to thank you all and thank everybody who listened. And If you enjoyed it so much you want to watch again, pretty soon the video will be on our website and you can enjoy it and share it with all your friends. I hope you will. So with that, thank you all and be safe.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.